Canadian income taxes explained. This is your introduction to taxes in Canada. If there are two things in life that are guaranteed, one of them is death. What a way to start off a video, I know. The second guarantee is taxes. And boy, do we pay a lot of tax in Canada. We have sales tax, land transfer tax, carbon tax, and tariffs. It doesn't just end there. There's taxes on property, taxes on assets, and the topic of this video, income tax. In this video, I'm going to provide you with an overview of the Canadian tax system and the rules for individuals so you can maximize your tax refund/benefits and minimize your tax liability. Hey, what's up everyone? Welcome back to the channel. I'm your host Danish, and I make personal finance, investing, and real estate topics easy to understand and keep up with. Believe it or not, there was a time when Canada was a tax-free haven. Canada prided itself on a no federal tax regime and viewed it as a way to attract skilled immigrants, investors, and capitalists. Instead of collecting tax revenues, the government made money by mostly selling off natural resources and charging high custom fees on imported goods. In 1917, the income tax was introduced as a way to pay off for World War I, and it was meant to be temporary. But once implemented, the government was unable to let go of this profitable stream of revenue, and we've had it ever since then. The Canadian government collects taxes as a source of revenue to pay for social and economic programs. Tax laws are set both by the federal and provincial governments, although tax collection is generally controlled by the federal government through the Canada Revenue Agency, or the CRA. The federal government collects all federal personal income taxes as well as income taxes on behalf of the provinces and territories except for Quebec. The CRA also collects corporate income taxes on behalf of all provinces and territories except for Alberta and Quebec. In Quebec, the government has its own collection process through Revenue Quebec. After the CRA has collected all federal, provincial, and territorial taxes, it then remits those tax dollars back to the provinces and territories. Income is taxed at both the federal and provincial/territorial levels. The federal law for taxing income is known as the Income Tax Act, which sets out the rules for both businesses and individuals. The Income Tax Act usually goes through very important changes year over year every time the federal government sets out its annual budget. These changes will have an impact on how much tax you have to pay year after year. Provincial tax is calculated based on the various provincial and territorial laws found in each provinces and territories. Together, the federal and provincial tax rate is called the combined tax rate. Tax reporting. You are required to report your income every year to the CRA through a process known as filing a tax return, which can be done both online and through pen and paper through the mail. In this tax return, you must list all your income sources, as well as note your eligibility for any tax deductions and tax credits. The tax system, it's based on trust. Although the CRA knows some of your sources of income, they mostly rely on citizens to self-report their income accurately on their tax returns. The CRA recommends that you file a tax return every year, even if you don't earn any money. The reason? If you don't file your taxes, you may miss out on free money. Some examples you may be eligible for include the child tax benefit, the GST/HST credit, and the guaranteed income supplement. The CRA enforces the tax law each year by performing several audits on both businesses and individuals. If the CRA finds you made an error in calculating or reporting your income taxes, you will be reassessed. And if the error was deliberate, you will be faced with penalties. If someone is found to be evading the tax law, they will be prosecuted by the Department of Justice for tax evasion or a criminal offense. This brings me to my next point. What types of income are taxable? Individuals and corporations are taxed on their total income after subtracting allowable deductions. There are 4 general types of income that are taxed. Number 1, employment earnings, which generally applies to individuals. Number 2, profit from a business activity. Third, investment income from a property or investments. And number 4, capital gains on the sale of capital property. There are different rules that apply to each source of income, and this will impact the amount of taxes you will ultimately have to pay. To file a tax return and to claim your deductions, it's very important to know the source of your income so you can file your taxes accurately. Employment income is when someone earns an hourly wage or a salary paid by an employer. It can also include vacation, gifts, and any added perks that you receive from your employer as part of your employment arrangement. There's also a difference between employment income and business income. Business income can be earned by an individual, a partnership, or a corporation, and includes any money you earn from a profession, a trade, or any other business activity where you expect to make a profit. For example, let's say outside of my day job, I go outside and I start selling widgets. And if I make a profit from selling those widgets, I'll have to pay tax on those earnings. Not only do I pay tax on my employment income from my day job, but I also have to pay tax on the side hustle. The tax law also requires a taxpayer to pay tax on income from a property, which can include interest from investments, loans, and rent from investment properties. But the good news is you can also deduct certain expenses that are directly related to earning this type of income. Looking at tax on capital gains. If you sell capital property, such as stocks on the stock market, for more than what you paid, the difference between the selling price and the price you paid is known as a capital gain. If you sell something for less than what you paid, the amount of loss is considered a capital loss. If you have a capital gain, only 50% of the gain itself will be taxed. Meanwhile, a capital loss can be carried forward to future taxation years to offset future capital gains if you have no capital gains in the current tax year. Under the Canadian tax system, money is divided into income brackets, which ultimately determines your tax rate. A very common mistake that a lot of people assume is that all income is charged at the rate of the highest tax bracket. This isn't true. In fact, we are charged progressively, meaning first, you pay the rate on the lowest tax bracket and only pay the higher rate for each additional dollar earned. This is also called your marginal tax rate. Let's run through an example so you can see how all this works. Let's say you live in Ontario and made $50,000 of employment income. You can see that your total tax on that $50,000 is $10,775, meaning that on average, your tax rate is 21.55%, right? So if we take $10,775, divide that by $50,000, you'll get 21.55%. The other tax rate you want to know is your marginal tax rate, 29.65%. That means for every dollar you earn on top of this $50,000, you'll pay tax at 29.65%. And you'll pay this tax rate until you move on to the next tax bracket. So you can see that you'll be paying 29.65% combined for both federal and Ontario until you reach $79,505. Once you go to the next tax bracket, your marginal tax rate will be 31.48%. And it goes higher and higher until your marginal tax rate is 53.53% when you earn income over $220,000. So going back to our example, let's say now you've made $80,000. Notice now your average tax rate is 25.29%. That means on average on the $80,000, you've paid $20,236, which is equal to 25.29%. But your marginal tax rate is 31.48%. That means for every dollar earned above $80,000, you'll have to pay 31.48%. Some find this graduated system to be fair, while others feel it burdens hard workers, penalizes success, and discourages prosperity. If you are in the highest tax bracket in Ontario, your marginal tax rate is over 53%. Meaning, for every dollar you earn above $220,000, you actually get to keep less than 47 cents on every dollar. More than half your income at that point goes to the government. But Canada isn't the only country to have a system like this. A lot of other countries use a very similar progressive tax structure, although the tax rates and the tax brackets may vary. So now that we know what types of income are taxable, let's talk about what types of income are tax exempt. Income exempt from taxes includes most lottery winnings, most gifts, child benefit payments, the GST, HST credit, payouts from a life insurance policy, scholarships from school, withdrawals from a TFSA, and strike pay from a union. Now that we've covered the income side of the equation, in terms of what's taxable income and what's non-taxable. Let's talk about the other side. What are tax deductions and credits? There are two main ways to reduce the amount of taxes you have to pay. One is by claiming tax deductions, and the other is by using tax credits. Deductions are amounts that you can subtract directly from your income before having to pay any tax. There are not as many deductions available to individuals who earn employment income as compared to individuals who carry on a business. However, some common deductions available to individuals include support payments made to an ex-spouse, contributions made to an RRSP, and moving expenses if you moved more than 40 kilometers because of work. Tax credits, on the other hand, work a little bit differently than tax deductions in that they are subtracted from the amount of tax you owe, as opposed to your income before taxes. The most common tax credit that everyone can claim is known as a federal basic personal tax credit. This allows you to subtract an amount from your taxes set by the federal government. For the 2020 tax year, the federal basic personal amount is $13,229, as long as your net income is $150,473 or less. What this really means is that an individual Canadian taxpayer can earn up to $13,229 in 2020 before having to pay any federal income tax. For the 2021 tax year, this basic personal amount goes up to $13,808. Additional federal tax credits and benefits include an amount for a dependent spouse and children. In this case, a dependent spouse can also be a common law partner. You may also be able to claim a disability amount, caregiver expenses, medical expenses, college or university tuition amount, and the Canada Workers Benefit. These are just a handful of benefits and tax credits for the purposes of this video. Be sure to speak to your tax accountant when filing your taxes to see what credits and benefits you are eligible for based on your own unique tax situation. There is one other tax planning strategy that you can use to reduce your taxes even further, and that's by using a corporation. If you're a freelancer, a gig worker, or own a small business, consider switching from a sole proprietorship to a corporation. While incorporating does come with a heavier compliance requirement and a little bit more complicated tax return, it could also drop your tax rate significantly. In Ontario, for example, high earners would go from a marginal tax rate of 53.5% to somewhere around just 13.5%. However, that's only on income earned inside of a corporation. Once you transfer the funds to yourself through a salary or a dividend, you'll pay tax on your regular marginal rate. This tax planning strategy may be something you can consider, but be sure to speak to your tax advisor or CPA. I have links in the description to books that I've read that have made a profound impact on my financial journey, and I hope they make an impact on your journey. I also have links to promo codes in the description for various discounts and sign-up bonuses. So I encourage you, please be sure to check out those links, as this is a great way to support the channel so I can continue making content like this. Do you have questions for me, feedback on this video, or ideas on future content? Be sure to leave them in the comments below, and while you're at it, make sure you've hit that like and subscribe button. That's it for now. I'll catch you guys in the next one.